The Fed is encouraging risk and they know it, but does it even matter? You came here for the truth, so let me unveil that for you. We need to discuss three topics today. Number one, we're going to look at the Fed shock. They spooked the market, let's be clear. Now, the markets have actually rebounded from that, and I'll give you the insight and what you need to know. But this is very important that whatever the Fed says, the market is so tied to it. It's so interconnected. I want to look at what Dalio had to say as well. He has an important message that I wanted to share with you. And then we can look at debt growth. Debt growth is so key because when you see what's been happening, the expansion of that debt is never leading to more growth. All of that and more, let's begin. Another update here on the Fed repo operations. You can look right here as we scroll down. It is at $765 billion for this reverse repo operation. It continues on and keeps getting worse. Of course, the Federal Reserve is making it more attractive because they actually increase the rate that the banks would get if they deposit their reserves there. So look for this to potentially hit $1 trillion in the near future. I'll cover that for you. Stocks rebound as Dow gains more than 550 points. So you could look around and see what had happened, but I'll just show you on the chart itself. You compare the S&P 500, the NASDAQ right here, and of course, the Dow Jones. And it looks like these are daily candles, by the way. On the daily, we could see that the Dow Jones had come up the most, but it might be hard to see. I'll pull out the highlighter on this. This right here is the 50-day and 20-day moving average, and it is still beneath that. So if it goes positive for one more day, it's going to accelerate beyond that. So I'm going to keep a very close eye on what happens here because the Dow Jones is a leading indicator. If you look at the Dow Transport and of course the Dow Industrial, you compare these two together, and when they start to come down, Alessio Rastani did a video about this whereby basically you watch those two, they come down by 3%, they rise up by 3%. There's a few more factors in there, and essentially that had actually triggered. Now it's coming back up. So if it goes back above these moving averages, then that no longer persists. So I'll keep an eye on it, and if it's really key, I'm going to bring a video on that specifically. I also wanted to show you the dollar. Take a look at what happened with the dollar. I mean, they basically promised to continue to print money here. They promised that they would do this, and it's performing so well. Of course, they're performing against its peers, which are all weak, but I'm just showing you, if you look at this in the last few trading sessions, the direction has clearly been upward. Okay, you can see what's going on with gold as well. Over the past couple days, it has come up a little bit, but I mean, come on. The direction has been down recently, even though we should be concerned about the amount of money that they've been printing. US dollar faces volatile week as the Fed policymakers line up to speak. I believe there are something like 16 different speaking engagements that are going to be taking place from people at the Fed. 16. Do you think that had any relevance to the market being spooked? Obviously, the Fed shocked the market. That's clear. Fed's Bullard, Kaplan, and Williams are scheduled to speak on Monday. 3 on Monday alone. Powell will testify on Tuesday. Inflation data is due on Friday. So look for future videos I will do. Of course, I'm going to bring that all to you. You know that you got to come here for the Fed info. Fed officials opened the debate on bond taper. I would actually argue that they haven't done that, at least officially, yet at this point. But that's what they're saying here in this article. There are a few things that I just wanted to touch on really quickly. There were a few quotes from these individuals. Creating optionality for the committee will be really useful, and that will be part of the taper debate. And as we think about how much signaling we are doing about future rate policy, you see, even what they're doing, their forward guidance, they can't necessarily give too much away. They have to watch each and every word because you spook the markets. Even though they promised that they wouldn't touch this, they wouldn't even talk about this until the next meeting. Just the fact that it was coming in the future, acknowledging that the Fed taper, and of course, what they're doing with the interest rates, which first it's the taper, then interest rates come later. So imagine that. I mean, that's how important the Federal Reserve really is. This is Kaplan. I've been more of a fan of doing some things maybe to take our foot gently off the accelerator sooner rather than later so that we can manage the risks. They want to avoid having to press the brakes down the road. Of course they should. They should not be going so aggressively, but here we are. Now, Dalio as well as Summers, I'll just show you the quote from Dalio, still see risk in the US as it overheats after the Fed's shift. Yes, of course. Of course, because you know what they're going to do. If the markets come down by 10%, the Federal Reserve is going to come in. Straight up fact. 10% down, you have at least a whole bunch of reinforced beliefs coming out of the Federal Reserve, the forward guidance. Don't worry, we're going to take care of you. We're going to put you to sleep. We're going to rock-a-bye baby in the treetop. We'll take care of it. Don't worry, because we're the Fed. That's what they do. I mean, really, it is what they do every single time. But will their actions have the same impact as they did before? It seems just like any alcoholic or drug addict, you have to give more to have the same effect. That becomes a very expensive habit. It's easy to say that the Fed should tighten, and I think that they should, but I think you'll see a very sensitive market and a very sensitive economy because the duration of assets has gone very, very long. Just the slightest touching on those brakes has the effect of hurting markets because of where they're priced and also passing through the economy. Very good points here, okay? Now, this article was talking about lumber, and I had done a video, just an interview actually, a couple days ago with Michael Gayed, and he explained the lumber to gold ratio. He explained what it tells you, and of course, what it doesn't tell you. That's all explained in there, so definitely check it out. From sawmills to store shelves to your own hammer swings, lumber can tell you a lot about what's going on in the economy right now. That's why I did that video with him. I think it was so important. One of my worst performing videos I have done in a very, very long time, though it was extremely informative. Anyway, lumber prices have soared. They've come down by approximately 50%. The housing and renovation boom drove insatiable demand for lumber. And then it goes on. It was more than 1,600, actually it was almost 1,700, and now it is, the last time I checked anyway, around 900. So from 1,700 approximately to around 900, it is down significantly. Quote, many of the extreme price spikes that we've seen in recent months are likely to reverse for Econ 101 reasons, essentially saying supply and demand factors. We'll see if that's actually the case. Now, of course, you've got what's going on with oil, but anytime you are thinking about oil, keep it in your mind to think about the whole New Green Deal, the green economy, eco-friendly, solar panels and wind and all these different things, which, let me tell you this, whether you're on the side and favorable in that direction or not, understand that there are billions and potentially down the road all throughout these years, if you look on a global scale, trillions of dollars being invested into this. We have to take that into account. So what's happening? This company right here, you might have heard of them, Exxon, although right now they're kicked off the Dow. But in 2013, were the actual biggest company in the world, they prepared to cull US white collar ranks by up to 10%. They're going to, as they say here, performance improvement program will involve 5 to 10% annually. Reviews are separate from sweeping job cuts disclosed in 2020. So they're just going to shrink the company down and down and down. What does that tell you about what's happening in this industry? 2013, biggest company in the world, kicked out of the index several years later, and now going to shrink the company down 5 to 10% per year. If you are in this industry, of course, there's going to be demand for a long time, but take a look at this information and see what it really means to you. This article, as they have basically every single day, is talking about the chip shortage. The global chip shortage is pushing up prices of items such as laptops, printers, and is threatening to do the same to other top-selling devices, including smartphones. They give several examples in here of these different items that are going up considerably in just a period of time. And a lot of people, they think that if the raw materials are going up, well, the corporations are going to pay for it. The corporations are going to take that out of their pocket. I don't know why anybody would believe this, but I've seen it time and time again. If you actually look through the articles, look through the statements, what I've just highlighted here, HP has raised consumer PC prices by 8% and printer prices by more than 20% in a year. Go down further, Dell. As we think about component cost increases, we'll adjust our pricing as appropriate. And it goes on. Okay? Heinz did it, and so many other, Procter & Gamble and all these mega conglomerates have all said prices are going to rise. We need to wake up. We need to get serious with this information right now. Not tomorrow, not next year, right now. Number one, Ray Dalio has warned that there's too much debt, too much inflation. Now, we didn't need to be told that, but understand it in the general outlook of what's happening today. Number two, history has shown us time and time and time again that this ends very badly. Number three, investors right now, today, you must be cautious and calculate your risk. As I like to say, passive is massive. Okay, we need to understand what that means. You've got income coming in. That's going to be extremely important. It could come from multiple sources. I talk about this all the time. Got videos in the playlist for you to check out. Really good article right here out of the Wall Street Journal. It gets into many factors, but I wanted to touch on this point here. China remained the largest investor in the world, partly thanks to its continued expansion of its Belt and Road infrastructure project over the last year. Some European countries also are starting to block Chinese involvement in their economies, drawing closer to positions advocated by the US. Governments from the Baltic to the Adriatic Seas have canceled public tenders that China's state-owned companies were set to win, or moving to a ban on Chinese companies from investing or contracting in their countries. Look for which countries are doing this and which ones are shaking hands. I think this is going to be really key for the foreseeable future. Okay, we know what's going on. Now, this right here, I wanted to touch on it because I think that you're not going to find this type of information, looking at this. There are a few charts. I've shown you this before, but I think it's really key. Really quickly. US Fed debt and Fed balance sheet projected through 2050. It is very clear that yes, you're going to have a period of time in which there is an expansion of the debt. They're going to enforce this as the rule. No, we're just going to expand forever. Well, as a result, the Federal Reserve is going to have to monetize some of that. So it means that their balance sheet needs to increase as a result of that. They're monetizing potentially, let's say 30% of the total debt. That means their balance sheet is going to go skyrocketing higher at the same time that the debt does as well. But are they going to monetize it all? US Fed debt and 10-year average GDP growth projected through 2050. The whole point here, and I think maybe the next one as well, is that you pump more debt into the system, but you get less growth as a result. Simple matter of fact, look at it historically, look at it all around the world. It is true. Dollar of debt to create $1 of GDP. Again, more money you pump into the system, the less effect it has, just like an alcoholic, just like a drug addict. And this right here just shows you Japan. They have been pumping all of this money in, okay? Doing so much, trying so hard to expand their purchases. As they say here, they've got, basically everything, the majority of the ETFs, corporate and government debt markets. And they own everything today. And yet, you're getting less growth, you're getting a consistent and never-ending recession. This doesn't work never has, and never will. If you want the latest and greatest detail, you gotta be on the insiders. It's so easy to get into this, and now we have over 4,000 people. It's free. All you gotta do is sign up at themoneygps.com, and I will send you an email 5 times a week with the latest video. And soon, in the coming weeks, it's going to include details that are gonna be original, so you definitely want to check that out. If you like the video, hit that thumbs up button, and don't forget to check out this video right here. It is so informative. Take a look. I'll see you there.